Hello, this is Gauri Gaur. Valuation of inventories. Accounting Standard 2 helps in determining the value of closing stock at which the inventory should be shown in the balance sheet till it is not sold and recognized for revenue purpose. Now, what is concept of inventory? Inventories include the following goods which are held for sale in the ordinary course of business, that is finished goods, used in the process of production of such goods sold, that is raw material, work in progress, which does not include in machines, materials or supplies to be consumed in production, processing or in rendering services, that is stores, consumable, spares, etc. Inventory also includes machinery spares that are not used for a specific or particular fixed asset, but are used generally for various items of fixed assets. What is the scope of Accounting Standard 2? AS2 valuation of inventory is not applicable for, that is in work in progress of construction contract or work in progress arising under business for a service provider. Financial instruments like shares, debentures or other securities. Producers inventory, which is naturally available product like livestock, agriculture or forest products, mineral, oils, ores, gases, etc. These are valued at net realizable value. AS2 states that inventory should be valued at lower of cost and net realizable value. Moving ahead with cost of inventory, it includes cost of purchase, cost of conversion. See, cost of conversion and other costs incurred to bring the inventory in current state. Let's discuss these in detail. Cost of purchase includes purchase price, duties and taxes, freight inward expenses, etc., which are directly related to the acquisition. But what it does not include? Duties and taxes recoverable in form of credit or refund from tax authorities, trade discount, rebate, duty drawback, etc. Cost of conversion, it includes cost directly related to the units, that is direct cost like direct material, direct labor, other direct expenses, and systematic allocation of fixed and variable production overheads incurred to convert material into finished goods. Moving ahead, let's discuss certain other concepts like fixed production overhead and its allocation, indirect cost of production that remains constant in spite of the changes in volume of production is fixed production overhead, for example, depreciation and maintenance of factory building, cost of factory management, etc. Such fixed production overhead is allocated to units of inventory on basis of normal capacity of a factory. However, if the production is abnormally high, the amount of fixed production overhead will be allocated to each unit such that the inventory is not measured above cost. Variable production overhead and its allocation. Indirect cost of production that varies directly with volume of production, that is variable production overhead, for example, indirect material, indirect labor, etc. These overheads are allocated on basis actual units produced. Where cost of conversion of an individual product is not identifiable separately, the total cost of conversion is allocated on basis of relative sale value of the product. On processing, if byproducts, scrap or waste materials are resulted, they do not have material value. They are measured at net realizable value, which shall be resulted from cost of conversion. The remaining net conversion cost shall be distributed among the main products. But what are the exclusions from cost of inventories? Abnormal loss of material, labor, storage cost, administrative cost, interest and borrowing cost, unless AS 16 comes into picture. Net realizable value, it is the estimated selling price in ordinary course of business less estimated cost of completion and expenses to make the sale possible. Realizable value of material and supplies used in production of finished goods is estimated as under: if finished products for which material and supply are used is sold at cost or above, then estimated realizable value will be valued at cost even if its actual NRV is less than cost. If finished products for which raw material is used is sold at below cost, then estimated NRV of raw material is equals to replacement price. Let's discuss various significance of inventory valuation. Value of inventory affects the true and fair view of financial statements. It also affects the profits of the entity, that is business entity. Or inventory valuation also plays an important role in cash credit or working capital loans. It helps in determining the investment in working capital. Concept of conservation is followed, hence by losses on NRV being less than cost are recorded. There are certain systems of maintaining records of inventory. These are periodic record systems. Under this system, the stock levels are viewed at fixed intervals, for example, at end of every month, fortnightly, quarterly, etc. All the items of stocks in the store are reviewed periodically, and the method helps in finding out the quantities of material of all types that are physically counted at a given date. Perpetual record systems. Under the system of recording the inventory, there is a continuous record being kept for receipts and issue of inventory by the stores department, and the information about the stock of materials is available at any time. The physical movements of receipts and issue of material are entered in the register, and it indicates the balance of each item of material in stores at any point of time, like days, hours, etc. It records the inventory either in terms of quality or quantity and value as well. Now discuss different methods of valuation of closing inventory. First in first out method, FIFO. Under this method, it is assumed that the goods or units of inventory that have flowed first in the entity shall be the first to be issued or sold. Thus, under this method, the units of inventory are valued at the cost of inventory batches that were first to come into the entity at the end of particular accounting period. In simple words, FIFO is the method of pricing the issue or sold of materials using the purchase price of the oldest unit in the stock. Second is last in first out method, which is LIFO. Under this method, it is assumed that goods or units of inventory of the most recent batch shall be issued to the production or be sold out first. The units sold or issued are valued at per unit cost of the most recent batch received and are continued to be valued until a new batch is received into the stock. Thus, it is a method of pricing the issue of material using purchase price of the latest unit of stock, and the units in closing stock are valued at the oldest batch possible. Let us see certain examples of LIFO and FIFO method. Next is weighted average cost method. Under this method, the issue price is recalculated every time after receipts of goods, considering the total quantities and total cost for calculating weighted average price or cost, and stock units are valued at such price. Let us see certain examples of weighted average cost method. Now, the disclosures required under AS2. Accounting policy adopted in measuring inventory cost formula used, that is FIFO or weighted average or specific identification method. Classification of inventories, finished goods, work in progress, raw materials, spare parts.